dovish tone from Fed Governor Chris Waller driving rates lower in today's trade. Markets are pricing in that the central bank is done raising rates. Our next guest sees the Fed starting to cut rates next year, and sharp ones. Joining us now is Deutsche Bank senior U.S. economist Brett Ryan. Brett, it is great to see you. Let me just, start here, Brett. Your big picture view. 2023, Brett. Obviously, the economy proved a lot more resilient than certainly what a lot of economists, strategists, investors thought. As you looked out at 2024, Brett, what's your outlook?
Yeah, sure. So thank you for having me on the program. And, with respect to your first question on, 2023, there are several reasons why the economy outperformed. Labor market was certainly much stronger. Fiscal policy was a mild boost this year that was unexpected. And really, the consumer headwinds haven't really picked up just quite yet, but they are, and they're still set to hit. Bank lending to consumers is at recessionary levels. You have delinquencies and credit card and auto loans that are really back or well above pre-COVID. And you have student loan payments now coming back in the fourth quarter. At the same time, you have business spending that's slowing. So we expect a mild recession, continue to expect a mild recession in the first half of next year, with 2 quarters of negative GDP growth and the unemployment rate moving up to 4.6%. And that's what prompts the Fed to start cutting more aggressively starting at the June meeting next year.
And I thought it was interesting in your note that you really did go back and say what happened in 2023. I'm really curious, and I've been asking a lot of folks this, kind of what lessons you learned from that exercise and from a year that really didn't turn out like a lot of people expected.
Sure. I think one of the things that was underappreciated was that, and that was a surprise, was really what happened with tax receipts and fiscal policy. You had bracket creep that resulted in large tax payments in 2022. That sort of reversed in 2023. So people had less withholding that resulted in sort of weakness in consumer spending in the first half of the year, but a bit of a comeback in Q3. You also had the employee retention credit that was unexpected. And those are the couple of things. But really the labor market, the strength of the labor market to this point was really surprising, I think, and especially labor hoarding. And one of the ways to think about it is, you have the quits rate, which is back to pre-COVID. You have the hiring rate, which is slightly below pre-COVID, but the layoffs and discharges rate, that's the standout here, and that's still at its lowest point in history, really. If you were back to the 2019 layoffs and discharges rate, we'd be close to printing flat payrolls at this point and possibly negative.
And so, Brett, just sticking with the labor market, so I'm just curious what you see for the labor market in 2024, Brett. I mean, there's been signs of cooling. Do you see further deterioration there?
Yeah, so, to date, through October, 70% of the job gains have been in just 2 sectors, and that's in private sector job gains, and that's leisure, hospitality, and healthcare and social assistance. Those are the 2 sectors that, not surprisingly, we're still trying to get back to their pre-COVID trend. But other sectors of the economy, the rest of the job market looks less strong. And the diffusion index for payrolls is now, towards the lows of the last cycle. We continue to see a slowdown going forward, and that's really driven by a slowdown in consumer spending beginning in this quarter. So you had a really strong Q3 that was surprising. Some of the high frequency data points to a sharp slowdown recently. We think that'll continue into Q1 and Q2. And again, that labor hoarding scenario can only last for so long without a demand upturn and demand coming back.
And Brett, you guys are also looking for 175 basis points worth of interest rate cuts from the Fed, starting in the middle of the year and then going from there. That feels a little more aggressive than some of the other predictions that we've gotten. What's the sort of primary differentiator, do you think, in your outlook versus some of the others that's informing that?
Yeah, absolutely. So it's really, again, when the unemployment rate's getting north of 4%, and particularly like 4.5, 4.6, that brings the other side of the dual mandate back into the equation for the Fed. And so it also increases their confidence that the economic, outlook environment, you have a loosening of the labor market that takes pressure off wages. And so that gives them the confidence that they can sort of cut more aggressively, getting back towards a more neutral rate of around 3% by early 2025. And again, we think neutral, the nominal neutral is around 3 versus the Fed's 250. So it's really all about the deterioration in the labor market, the weakness in the first half of the year, and that allows the inflation outlook to come down for them, and they can feel confident they're on track to get back towards target.
Brett Ryan, thank you so much for joining us today, Brett, and for that insight. We appreciate it.